Ted from Financial Knife and Fork. I am so excited to bring to you a course on financial literacy. This course is going to be in a few different parts. We're going to make sure I split it up, and it'll be on YouTube as one video. We'll do part one and part two in case people want to skip ahead. And I'm also going to drop the link in our description box where you can find the complete just PowerPoint of our course, and it's absolutely free because this is what we do it for. But this course on financial literacy is going to start when you first get a job. What are you going to do? What you're going to use to save? What things do you need to save for? And then it's going to evolve into different things such as like investment vehicles and different things you can do with your money. And then at the end, we're going to just go over financial terms that you should know, especially just starting out. I think it's going to be fantastic. I hope you love it. Please share with whoever you need to, whoever you think you might even benefit from this. This is going to be good stuff. All right. So a course on financial literacy. So you're getting a job, and this all boils from, it starts when I was, just fresh out of grad school, and I got my first job, and I didn't even know what a 401k was, and no one explained it to me. So me and my infinite wisdom said I didn't need to put money in my 401k, and I missed out of a lot of money because I started working in 2009 when the stock market started to recover, and I did not start investing full time in a 401k until about 2014. So yeah, I missed a lot of money, and that's unfortunate. But anyway, I'm talking too much. What is a 401k? A 401k is a tax advantage defined contribution retirement account offered by many employers to their employees. It is named after a section of the U.S. Internal Revenue Code. What the hell does all that mean? All it means is a 401k is a retirement vehicle that you can put money in, and it is going to be taken out of your paycheck every 2 weeks. And that's what they say here. Workers can make contributions to their 401k through automatic payroll withholding, and their employers can match some of all of their contributions, which is important. I'm going to tell you all why in a second. So let's go over 401k limits. So any particular year, a calendar year from January 1st, whatever the new year is, to the last day in December, there are limits you can put on in your 401k. 2020 is ending. The limit was $19,500. That is the same. It remains unchanged in 2021. So I did a breakdown for you, and this is what I do. If you do max out, if you're paid bi-weekly, most people are, you get 26 pay periods, and you're working 52 weeks. To achieve the max, you need to put $750 per paycheck. That is a lot of money. I'm not going to lie to you and say, oh, you should be able to do that. No, it takes time to get your lifestyle down. It takes time to know how much money you're going to need and live on. But you got to realize you have to put money towards your future. And this is pre-tax. And this is important. Pre-tax. What does this mean? It means that if you make $100,000 when you file your taxes, if you max out, you're going to be at about $80,500. That's how the IRS is going to look at how much of your earnings that you actually made. Now, if you don't put anything in your 401k, they're going to look at it as, no, you made $100,000, and we're going to give you a tax, and you're going to have to pay your tax bill on $100,000. But if you put however much money in your 401k up to the limit, they're going to tax you what's there, which is 80,000, 90,000, whatever it is. It's going to lower your tax liability. And that really helps comes, tax year. Now, this is important. Employer match. It is free money. Don't leave it on the table. If you can't put up $750 per paycheck, I understand. It's a lot of money, but you can definitely get that free money. And I recently just saw something that was unbelievable. Someone that I know got a Fortune 500 company promotion, or hired, and they told me how much they're matching. And this company's matching 66%. I've never heard of that. The highest I've heard is 19, 20%. And I've never heard 66% before. And I had to see the documents for myself, 66%. So if you max out, they're going to max 19,500. They're going to put up to 66% to match you each pay period. That's a lot of damn free money. But I'm going to give you a real life example talking about my 401k. January 2020, I literally had about 99,000 and some change in my 401k account. It is December when I am recording this. This is the beginning of December. I've maxed out through most of the year, so $750 per paycheck, and I'm literally not even at the 19.5 mark yet. The employer match, they only match up to 5% of what I put in. Literally, my contribution is, instead of 19.5, it's around 25,000 even. But with the gains throughout the year, I'm at 30,000 in my 401k up. That's why employer match is important. If I had just put my money in, say it's, I would say maybe I'm a few thousand off. Say if it's only 18,000, I wouldn't have the employer match or the full employer match. So instead of being 30 up, I'm gonna be down. I'm gonna be 22 up, whatever the case may be. But it's important because at the end of your tenure, wherever you are, and you want to look at your 401k, you're going to say to yourself, well, how much free money did I leave on the table? And you don't want to do that. So that's what a 401k is. It is a retirement vehicle for you. We go over the limits. It's pre-tax, so you're not getting tax out of this money. This money is going straight to your 401k provider, and hopefully you can pick the right fund and it grows over time and your employer is matching your funds. That's so important. So again, I'm going to go over 401k. That's the first thing you can do. That's the first thing you say, oh, I want to fill this out to do my 401k. Every time you get money now, after that, after your insurance, after, whatever else you may have, insurance, life insurance, medical stuff, now you have your net, and net means after taxes. And that's where a Roth IRA comes in. So many times over, people will ask, what do I need to invest in? You need to invest in yourself. Are you maxing out your 401k? If the answer is yes, that's fantastic. Now, what are you doing with your after-tax money? Here, I have Roth IRA. The limits, again, there's a limit for 401k. There's a limit for Roth IRA. In 2020, it was 6,000, and in 2021, it remains unchanged, 6,000. Now, remember, after tax, this is important. Pre-tax and after tax. After tax means this is the money already in your pocket. So you're putting it in a Roth IRA. And what I love about these retirement vehicles, which people don't look at, is it's a built-in emergency savings, especially with the Roth IRA. The contributions can be withdrawn at any time without penalty, with no penalty, meaning if you put 6,000 in 2021 and you get in a jam, you can take out $4,000 and you have no penalty because it's already after tax. You've been taxed on that money. That is your money to spend however you want. Now, this is where it gets kind of semi-complicated. So within your Roth IRA, you're able to invest, say you put 6,000 in your Roth IRA in 2021. You invest within your Roth IRA in some stocks that appreciate. So instead of 6,000, they have 10,000 in your account. So that 4,000 is capital gains. Now, if you get into a jam and you need to withdraw all 10,000, that 4,000 is going to be taxed at a penalty because you withdrew it before 59 and a half. So that's the only thing you have to pay attention to. Your contributions, take out anytime. You've already paid taxes on that money. But if you made capital gains and you take it out, you're going to be penalized. Now, this is great. SEP IRA, this is my favorite savings mechanism, bar none. But the caveat is you have to be essentially a business owner, or you're a freelancer, you're a person. Hey, my OnlyFans people out there, you are actually a business, even if you're not incorporated. If you're making money and you're a 1099 employee, you can use a SEP IRA because you are in fact a business. A SEP IRA is an employee-sponsored retirement plan that can be set up by sole proprietors, partnerships, and corporations. So SEP IRA annual contribution limits are significantly higher than those for traditional IRAs. So bet you have a 9 to 5, you decide to make a business on the side. You can have a SEP IRA based off your business on the side, whatever it may be. Say you, I don't know, decide to open up a donut shop, whatever, and as soon as you get off work, you're selling donuts. This is the big advantage. Say you gross, well, let me read this first. It is one big advantage of the SEP IRA is the amount that can be contributed annually. As of 2020, contributions cannot exceed the lesser of 25% of the employee's compensation for the year, or $57,000. In 2021, it'll be moved to $58,000. Okay, what does that mean? Pay attention to this. The lesser. So in your donut shop example, you made $100,000, all right? And, you can put it into a separate IRA. Now, based on this definition, it is the lesser, okay? So it's 25% of the employee's compensation for the year, or $57,000. So the $100,000, 25% of $100,000 is $25,000 all day long. So it's going to be less than the $57,000, $58,000 in 2021. So you can only put up to the lesser amount. However, now let's take the flip. You had a great year. You made $500,000. Now 25% of $500,000, or $58,000. It's going to be the lesser of that amount. So it's going to be $58,000. So it's whatever the lesser amount is, but it's really simple once you get a hang of it. And it's like, wait, I'm making extra money. I'm sending, I'm a boutique owner, or I make hats, or I'm a craft person, and I'm just sending things out. I'm a consultant, and I'm making money from people, and literally I am my own sole proprietor. In that point, you can use and open up a SEP IRA. It is a fantastic savings mechanism. It's better than 401k. It's better than Roth IRA. It's better than a lot that's out there. That's why I want to make sure I have that in there. Okay, so this is important. All right, I wanted to start with a 401k. I wanted to start with a Roth. I wanted to start with the SEP IRA because I wanted you all to be thinking retirement first instead of, okay, well, what about my everyday money? Well, your everyday money, your emergency savings, all of that stuff, you want to look into online banks. Online banks allow you to do everything via the internet, and that's all that means. And why do you want to do it? It's a higher annual percentage yield. You go look up, if you're in a major bank and you have a regular savings, regular checkings, go to their website, go to your bank statements, and look how much you're getting paid every month. I guarantee you getting paid pennies on the dollar. If you're getting $1, you're getting $2, you may be lucky. That's because they're paying you 0.1 annual percentage yield. So when you see APY, that's what that means. So you need to be thinking in your head, well, I need to get more on that than my money. Now, I want you to remember, pre-pandemic, online banks were doing well. They were paying out 2%, 3% sometimes on annual percentage yield. So I actually like getting $100, $200 every month just for my money being there. Online banks pay higher annual percentage yields than major banks. Now it's a little bit lesser, but it's still more than what major banks will give you. And there are different examples. You can go Ally Bank, there's Discovery Bank, Synchrony, all these places, Citibank, they are paying 0.60 or 0.70. They're at that, but it's still great getting $50 and $60 each and every month. But you need to be thinking, okay, well, I can't go into the bank, like a physical bank. You're going to have to do everything online. And honestly, I had to make myself go to the bank when I was still at a major bank. Now, online banks, it makes just more sense. I'm doing everything online anyway, and I'm getting paid more. So when you think about, I'm getting a job and I'm finally getting money, where do I need to put this money? What's the best place for me to have this grow? need to be thinking about putting in an online bank so you get a higher annual percentage yield. But most importantly, you need to be thinking about your retirement first. Okay, how can I get this ball rolling, and more importantly, how can I get my money to work for me and have experience the great concept of compound interest. We'll talk about that a little bit later, but that's what you want to do. When you get a job, you want to think how much I can put in my 401k, and if I can't max it out, what's the employer match? What's the highest I can put in? With the Fortune 500 companies, hey, you're going to be great. You're going to do fine. You just put up as much as they will allow you to put up. But if you max it out, you need to be thinking, okay, what's the next thing I need to do with my money? Roth IRA. If you hustling, if you just out there, you got a business on the side, or you just primarily a business owner, think about doing a SEP IRA. You have so many advantages being a business owner. So I get a job, got to get my 401k. If I can't max out, I need to be doing the employer match at least and get that free money until I can max out. And once I get over that threshold, I could be thinking about my Roth IRA. In a Roth IRA, you don't have to do it throughout the year. You can just write a check in the beginning of the year, end of the year, whatever, because there's no employer match. The SEP IRA, same thing. It's great mechanism. You need to be thinking what else I can do with my money. Now, your everyday money, your emergency savings, when you finally get into it, remember your retirement has a built-in retirement emergency savings in it. Something comes up, you can withdraw from that. But if you get to that point, you're thinking, okay, I need my everyday money, my bill payment money. You want to put it in somewhere that you're going to get the best annual percentage yield, which is an online bank. All right. Certificate of deposit. This shit is so funny because certificate of deposit, CDs, as they like to call it, is a product offered by banks and credit unions that provide an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. And that, you can tell, means you give me money, I hold it for a certain amount of time, and in this period, we're going to pay you XYZ, which is the annual percentage yield. This is something that is one of the first instruments I even knew about as a black person, because so many black people, older people that I knew, had CDs, and that's back when CDs were a little bit better. CDs were, at least 2%, 3%, 4%, even higher. But nowadays, it's just not that. I'm not a fan of certificate of deposits. I'm not a fan of CDs, especially penalties. So if you give somebody $25,000 for 2 years and you can't touch it, you know how much stuff can happen in 2 years? You maybe have to get a chance to, access that money, and they're going to penalize you on it. It's just not something I like, but I do want to let people know about it or make them aware of it, because it has a two-part mechanism. So one, black people have been using this for quite some time. And so I want people to be aware of it in case they hear about it and they're like, what's a CD? Or you just want more information on it. Two, CDs can work really well if you get a large lump sum of money at one time and you just need time to figure out what to do with it. And you want to make sure you can't access it. Or if you access it, it's going to be a penalty. If you get, unfortunately, things happen. Say if, you get into a car accident and you finally, get a settlement out the deal, or you go to trial, whatever, they hand you $75,000. You basically like, wait, I didn't know the 75,000 was going to come. I need to figure out how I'm going to invest this. I need to interview a financial advisor or whatever your process is. A CD allows you to put that money up and at least get something for your money until you figure out what to do. So that's the main focus. That's why I bring up CDs. Is the second part is it is a good function in case you need to buy yourself some time. All right. If you have children, this is important. It is a 529 plan. Your children, you want to make sure they have education taken care of. This is where college and all that stuff comes in. Each state has something called a 529 plan, and it's tax advantage accounts that can be used to cover educational expenses from kindergarten all the way through graduate school. So when they're 3 years old, all the way up until your children are 27, 28 years old, there are two basic types of 529 plans. There are savings plans and prepaid tuition plans, but I cannot stress to you enough, they vary. It depends on whatever state you're in, okay? And the contribution rules are different. But I did find that every state 529 plan allows for maximum contributions of at least $235,000 per beneficiary. And that's not per year, that's just, per the 529 plan. That's the floor of any state in the United States. For one kid, you can put up that amount of money and have it in there. Okay. Now, again, it varies. I didn't go in depth with this one because the rules can be completely different in Florida than it is in Illinois. So you want to make sure you look into a 529 plan if you have children and you want to save for them. And if you want to use this mechanism, it is a good way of thinking about it in the future. There's also Uniform Gifts to Minors Act. This is this is important. A UGMA account functions as a type of custodial account designed to hold and protect assets for the beneficiary. So all this means is you or whoever you designate, you giving this this account to a beneficiary, so your child. All right. So this provides a way to transfer financial assets to a minor without the time-consuming and expensive establishment of a formal trust. Most people ain't got a trust, don't know what a trust is. You can give them a UGMA, okay? This allows you to fund a child's education. Say again, you go in that scenario, things happen in life, you get into some type of accident where you have to sue someone legally, and you get some money, and you want to put some money aside for your child. You may not want to use a 529 plan. You can use a uniform gift to a minor. So you can use a UGMA and put that to the side for them for their education. Now, again, these are more complex financial vehicles for your children. You may want to make sure you talk with a financial advisor to understand exactly where you're putting the money. But these are things you can do when you get into the working world. You can get it 401k, you can get your IRA, you can get your SEP IRA if you're hustling on the side or you're a sole business person. From there, you have your online bank, you have your emergency savings, you have a certificate of deposit if necessary, but you want to put some aside for your children, especially if you have young children, you want to start early. You can use a 529 plan or a uniform gift to Minors Act. Right there, we just went through the whole shebang from start. You have a job to what you can do building up and through your family. Now, those are the foundation blocks. Those are the things you need to take care of. And I should have said this earlier. This is starting once everyone, gets rid of their debt. Not complete debt, but debt so much as no credit card debt. You want to take care of your car. Hopefully you want to own that. But if you're just starting, I understand things happen, but you just want to make sure you're taking the right steps eventually, and you want to eventually pay off that debt. But these are just steps you can take, and you want to make sure you have these things down. I cannot stress enough. You want to make sure you have these things down before you start investing. You want to make sure you have your retirement, your future taken care of. You want to make sure you have something away for your kids. You want to make sure you have, money to live on each and every day. But now here's the interesting part. We can go to stocks. Okay, so here we go. Part 2. This is part 2 of a course on financial literacy, and this is on stocks. So, the questions I get: how do you buy stock? I don't know that much about the stock market. Let me know what's the first step I need to do. Well, outside of education, the literal first step you need to do is get a stock brokerage account. A brokerage account is an arrangement where an investor deposits money with the local licensed brokerage firm who places trades on behalf of the customer. Whatever. All that's saying is it's like going on an online bank. You're at Capital One, you open an account. All right. But you're trading stocks, so you need to go on a institution that allows you to trade stocks. And I listed some of them here. It's Ally, it's Robinhood, it's Vanguard, E-Trade, Fidelity. You go online, you open an account, you fund the account. Fund it meaning you send $300 to your new Ally account, and that allows you to purchase stock. That's what a stock brokerage account is. It's basically a bank account, but it's a stock bank account, brokerage account. You are on a platform and you're buying stocks. I always put it here, Robinhood. I don't know how long they're going to continue to do this. When you sign up, they give you a free stock. And if you want to give me a free stock for this free information, hey, I appreciate it. I'm going to put my link in the description box of this video. And if you click on that and you sign up, you get a free stock. I get a free stock. It's a great thing. All right, next slide. I want to start with the very basic. I'm going to breeze through a few of these because I know this may be elementary, but some people may not know this. So I'm buying stock. What does that mean? You're buying a share in a public company. What's a public company? It's a corporation whose ownership is distributed amongst general public shareholders via the free trade of shares of stocks on exchanges. So a public company issues shares through an IPO, an initial public offering, and trades on at least one stock exchange. So you have a private company. What makes them go public? They perform an IPO, meaning initial public offering. That process allows them to go on the stock market. I give you an example. I always use Uber. Uber was not a public company back in 2016. Whatever year they became a public company, I believe it was 2019, they had an initial public offering. So as a private company, they sold their individual, I guess, interest in the company to whoever they wanted. But once they do an initial public offering and they list themselves on the public, anybody can buy their shares. Anybody. You can log in, do an account on Ally, and buy an Uber share. And that's all that means. So a public company is actually listed on a stock exchange and you can buy shares of their company. So again, I'll go over initial public offering. It refers to a process of offering shares of a private corporation to the public in a new stock issuance. Again, Uber is a private company, was a private company. They decided to have an initial public offering and they went public. And then people can buy shares. This is important. I wanted to put this down here. Companies hire investment banks to market, gauge demand, set the IPO price, date, and more. Sometimes on initial public offering day, you may be, tempted to buy a company and it participated in its very first day, like Uber's very first day. I bought some stock in it. One of the things I like to do is look at the investment banks. Are there like Goldman Sachs or whatever bank they went through? I want to know, what their pedigree is. Are they going to have a lot of problems? How the stock structure is? I mean, that's a little bit more advanced, but I think it's worth noting. That's why I always look for investment banks and whether it's reputable, have they had a sketchy past, and essentially, is my money safe if I start investing in this company from day one? All right. So we're going to talk about stock symbols, and it's really, really simple. The stock symbol is a unique series of letters assigned to a security for trading purposes. And stocks can be listed on different exchanges, but they're really just a shorthand way of describing the company name. Investors and traders use the symbol to place or trade orders, or to place trade orders. So all of this means, and I use my great example of AT&T. So AT&T is a long-time public company. Public company means they've already had their initial public offering. They're on a stock exchange and you can buy them. So when you go on whatever stock platform you want, whether it's Ally, whether it's Fidelity or E-Trade, all you do is log in. You're going to go to your trade function table and you got to put in their stock symbol, which is T. AT&T, their stock symbol is T. So you put in, I want to buy 10 shares of T. Your money is already in the account, is already funded. Now you have 10 shares of AT&T. Congratulations. And you're going to get some money, by the way, because it's a dividend stock, which we'll talk about in a second. But that's all a stock symbol means. It's nothing complex. You can't let me think of a long name public company. Berkshire Hathaway is one of the richest, the highest price shares in the world. Berkshire Hathaway is a very, very long name. Like, you're not going to type that in. You're going to type in their stock symbol, and their stock symbol is BRK. And they have two stocks, is BRK.A and BRK.B. So you can look those up and see how much they cost. But that's all a stock symbol is. Okay, so there are different types of stock. You can buy a growth stock, a value stock, and a dividend stock. Okay. A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks generally do not pay dividends. My favorite example is Tesla. Tesla is a very, very popular growth stock. They do not pay out dividends. So it can go from, which we've seen, it could be a $300 stock one day, and within a month, it could be $2,000 a share. So $300 a share, within a month, it could be $2,000 a share. That is a growth stock. That is a flat out definition. Same thing with Amazon. Amazon has never paid dividends since it went public in the 90s. It was a $2 stock when it debuted. $2, $3 stock, whatever it was. And today it's over $3,000 per share. So that's the definition of growth stock. A value stock. Value stock refers to shares of a company that appears to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, making it appealing to value investors. Blah, blah, blah. So a value stock is something, it doesn't matter if it's a growth stock, it doesn't matter if it's a dividend stock, it doesn't really matter. What they're saying is that stock is undervalued. So I showed you AT&T earlier. Say if AT&T is around $30 per share right now, if they had, I don't know, a bad day where, investors decide to say, okay, I'm going to move my money around, whatever, and it dips down to $18 per share, but the fundamentals that you're seeing, say this is a $30 stock all day long, makes it a value stock. You want to get, and whenever people talk about getting stocks when they're on sale, meaning it's a red day or the markets aren't performing well, that's when stocks are on sale. That's when you see the value. The value stock is trading at the levels that are perceived to be below its fundamentals. And I have benefited from that quite a many times. If I'm invested in waste management per se, waste management dropped down to $102, $101. I'm in my head thinking, oh, I need to buy some more waste management because now it's back up to 120. So those are the things you want to look at when you look at value stock. Next, my favorite, I always talk about it on the channel, dividend stock. It's a dividend stock is the distribution of some of a company's earnings to a class of its shareholders, meaning you. So you're an investor. I used AT&T earlier. You have 10 shares of AT&T. They are going to hand you money just because you bought shares of the stock. It's a beautiful, beautiful thing. So dividends are payments made by public listed companies as a reward to investors for putting their money into the venture. So meaning they are paying you. This is income that you're getting paid. And I love that. Not enough people know about that. So I mentioned AT&T. Clorox is another good company. And then I mentioned Waste Management earlier. All these public companies pay dividends. They literally pay you just for existing. It's a beautiful thing. So that's why I'm so passionate about it. And a form of dividend stock is real estate investment trust. You need to be aware of it. A REIT is a form of dividend stock. A REIT is a company, and this is the real estate investment trust. The shorthand version is called REIT. It's a company that owns and operates or finances income-producing properties. It generates steady income for investors and offer little in the way of capital appreciation. Meaning, if you buy a REIT, you want it to be flat. So if it's $20 in 2017, in 2020, it's $18. That's fine. That's what they mean. You don't see a lot in capital appreciation. Sometimes it does work that way, though. You get capital appreciation and dividends, and that's a good day. Okay, so most REITs are publicly traded like stocks. You only want to buy the REITs that are publicly traded, by the way. Some financial advisors may think otherwise, but don't do that. Some examples of REIT stocks are Reality Income, Stag Industrial, EPR properties. Generally, they pay monthly. There are some that pay quarterly. And essentially, REITs invest in real estate properties uh, like apartment buildings, cell towers, retail centers, warehouses. But my favorite one, to give you an example, like Reality Income, every Walgreens you've ever walked into, Walgreens does not own that building. A REIT owns that building, and more than likely it's Realty Income. So every time you go into Walgreens, CVS, I don't care, wherever, they don't own that building. They don't own the actual commercial building. So Walgreens, CVS, whoever, they pay the real estate investment trust, who is the landlord, to conduct business there. And as they take that money, then they turn around and pay the investors and pay me. I like it. It's a win-win for me. All right, so I want to talk to you all about a dividend reinvestment plan. So it's a byproduct of dividend income. So a shorthand version is called a DRIP. It is a program that allows investors to reinvest their cash dividends into additional shares or fractional shares of the underlying stock on the dividend payment date. I love it. I love it. So I'm just going to go to the example, which is a real life example. I currently have a dividend reinvestment plan, a DRIP with Realty Income. You receive $100 a month in dividends from Realty Income in March. Realty Income is $80 per share in March. Your $100 dividend purchases 1.20 shares of Realty Income stock, and it repeats the cycle the following month, meaning my dividends are buying more assets that's going to pay me even more the next month. So let's break it down. I get $100 a month just for owning Realty Income, however many shares that is. So I get $100 a month, and I get it in March. And if Realty Income costs $80 per share, that $100 is going to automatically be reinvested and buy a share of Realty Income. And that's where the fractional shares that we talked about right here come into play, because when you're in dividend reinvestment plan, it allows you to buy fractional shares. So I won't just have one share. I'll have that, extra based off the $100, and I bought it for 80, and then I got that extra little piece left. I mean, it's just something for you to know about. It's something that you can just put into an automatic account and not even think about it. And it's just something that people need to know about, because if you can put $100 a month, or you're getting $100 a month in dividends, and you just let that build up over time, that's that compounding interest, man. And it's just stuff you need to know, and more people need to know. All right, so part 3, we have gone through the stocks, and it was fantastic. I just went through each and every stock, each and every type of stock you can buy, a dividend reinvestment plan, REITs, public company, what you need to actually buy stock. Now, part 3 is going to be a little bit more advanced, because these are just basic terms that you need to know, and that will help you function as an investor if you want to legitimately become a serious investor and start investing in stocks. So compound interest, we started talking about that earlier. Why is it important to start early? Compound interest, or sometimes it's called compounding interest, is interest calculated on the principal, which also includes all of the accumulated interest from previous periods on a deposit. It can be thought of as interest on interest, and will make a sum grow at a faster rate. Compounding interest can make you a millionaire. And I underlined it because literally it can make you a millionaire. If you do compound interest and you just are diligent about it, you cannot avoid becoming a millionaire. You really cannot. You put $250 towards something, and the compounding interest allow it to grow. All right. So let's break it down. I think the best way to describe it is interest on interest. So that is the best way of saying it. You have a mutual fund. You put $10,000 in your mutual fund in 2020. In 2021, at the end of your end of the year, you look at your statement for the mutual fund, and it doesn't say $10,000. It says $10,400. Okay, you've made $400 profit. So the next year it's interest on interest. You're not going from the 10,000; it's going off the $10,400. Now the next year you might have 11 something thousand. Then the next year is 13, and then the next year is 17,000. That's when they're talking about compound interest, and that's you not even touching the money. You have to put it in the a reputable fund. You have to put it in a fund that has a yield, a good percentage yield of making money, an annual percentage yield. If you do that, the interest on interest will make a sum grow at a faster rate. So even if you don't put any more money in that $10,000, it's going to grow. I give you a real life example, which I love to do. It's 2020. I literally bought a mutual fund, and I used that metric. I put 10,000 in it, and this isn't typical. I just put it in at the right time. Within a month, it had $11,500 in it. So I had made $1,500. Now, at that point, I could have left it in, whatever. But the important thing is, what I'm saying is, I didn't put any more money in it. It just literally, I got $1,500 because the mutual fund went up. And I'm not saying that happens all the time, but that's what can happen over the amount of years. And that's interest on interest. All right, so I just talked about an annual percentage yield, the APY. It's the real rate of return earned on a savings deposit or investment, taking into account the effect of the compounding interest. Inflation, I'm going to drop down, is the biggest threat to your money. You have $1 million, that's great. Inflation is working against your $1 million. And that's why you want to be aware of it. Because if you're working at a company and you don't get a raise, you legitimately, you can think about it as you got a demotion. Essentially, you're making 100,000 and say inflation, which generally grows at 2%. So that 100,000 you didn't get a raise, you're actually losing money because inflation is going up. So you want your APY to beat inflation at least. It's generally 2%, but your region where you live and the different year, just 2020 could be a inflation, can cause inflation to go up because there are less supplies and stuff like that. So inflation could be 5%, it could be 7%. You could be living in San Francisco in 1980, and all of a sudden the real estate goes through the roof, and your region, your inflation region, is going through the roof. And yeah, it may be cheaper if you move, but you got to understand that inflation is a big threat to your money. So whatever investment you have, you want to make sure you have an annual percentage yield that is beating inflation's ass, because that's what's going to keep you and your family, ahead of the negative, impact of inflation. So APY is the actual rate of return that will be earned in 1 year if the interest is compounded. Okay. So when you put something in a mutual fund, you really want your investments to just grow at 7 to 10%. Now, the example I gave you was, not typical. It was an aberration, I'm sure, but it was a good aberration. I love that. I needed to happen again. But basically, you wanted to grow 7 to 10% each year, and that's what you're looking for in annual percentage yield. So when you find a fund or ETF or whatever your investment, or you just actually using your stock brokerage account to buy individual stocks, you want in the beginning of the year, you want the interest to grow on that, and you want an annual percentage yield that beats inflation. I know it may be a little complicated, and I'll try to break it down a little bit more one more time. So you have 10,000 in the account. You want it to grow to 11,000. That's a good annual percentage yield. At the end of the year, that's what you want. Okay. You don't want it to be $10,050, because that is a minuscule amount of annual percentage yield. And you need to be thinking, is this the right fund for me? Hopefully it is, and it just had a bad year, which can happen, but you need to be thinking about that. So if you have $10,000 and $50, profit from that, that's a horrible annual percentage yield. You want something a little bit higher, okay? You want it to grow a good amount. So hopefully it could be 11,000, 12,000, 13,000, whatever it is. That's what you want to have happen. All right, what is dollar cost averaging? And this is something I use and I love. And every month, basically, before I even read all this, dollar cost averaging means you're treating your investments like a bill. So if you have a $300 car note, you're treating your investments into the stock market like that car note. So you're putting $300 to the side to invest each and every month. And that's all dollar cost averaging is. But I'll read some for you anyway. The purchases occur regardless of the asset's price and at regular intervals, meaning I'm about to buy SPY, which is a popular ETF, and it's typically $350. But I did notice it's a little bit higher. It's like $360 something. So I'm going to be buying that at $360, and knowing no matter what the price is, knowing the very next day or the very next month, it could be at $340. I'm gonna still buy $340. It's going to average out. Basically, hopefully it's in my favor that every month I'm just dollar cost averaging. And even when the stock's doing well, I'm going to turn out well. Even when the stock's doing poorly, I'm going to turn out well because it's going to average in a higher amount. But that's me explaining it. Dollar cost averaging refers to the practice of dividing an investment of an equity up into multiple smaller investments of equal amounts spaced out over regular intervals. And I try to break it down on the front end. Basically, you picking a dollar amount per month and you're investing that dollar amount per month, no matter what. So this is a good way of reducing overall impact of volatility on the price of a target asset. How can I say this? And this is a good game because I learned dollar cost averaging and I didn't even know I was doing it yet. I ended up paying off my car, and I used that example just now. So I had a $300 car note, but that $300 went to somewhere else once I paid my car off. I never just said, okay, this is going into my savings. No, it's going to, at the time, I don't know if I had any more credit card debt. I think I was done with my credit card debt, but from that time, I just put it into the stock market, and that's what I'm doing each and every day, each and every month. Once I get all my debts paid, I'm still going to continue to invest like my debts are still there. So that's what the game I'm going to give to you all. Hopefully you enjoy it and love it. All right, let's break down quarters. All right. A quarter is a 3-month period on a company's financial calendar that acts as a basis for periodic financial reports and the paying of dividends. Okay. Quarterly earnings are a crucial piece of information for investors and analysts, especially for my option traders out there. It's very important that you know when earnings are dropping, but they're based off of these. Okay. Q1 is January, February, March. You can see the rest here. Q4 is October, November, December. Okay. We're in December, so we're in Q4. These are important so you know what people are talking about. So when you are tracking a company and you want to know how they're doing, you don't want to necessarily look at their annuals from last year because it may still not be applicable. You want to look at their last quarter. So if we're in December, all their 3-quarter earnings are out. You want to look at 3Q, not 2019 of their annual from last year. You want to look at the most recent documents, and that's how you know what it is. It's not complicated. It's just Q1, Q2, Q3, Q4. It's like watching a football game. They got 4 quarters to a normal football game. They got 4 quarters in a year. All right. I talked about this earlier, but a mutual fund. So a mutual fund is a type of investment vehicle consisting of portfolio stocks, bonds, and other securities. It gives small individual investors access to diversified, professionally managed portfolios at a low price. Investing in a share of mutual fund is different from investing in shares of stock. Unlike stock, mutual fund shares do not give its holders any voting rights. I wanted to read that because that's important, because I don't want you to buy a mutual fund with all these big companies, Google, Tesla, whatever, and you're thinking, oh, there's shareholder meetings coming up. They may have some votes. I may be able to vote. No, you cannot, because you just have a mutual fund. Now, if you want to have an actual vote, you have to buy an actual share. And then you will have a vote based on your amount of shares. But a mutual fund is important because understanding it's a portfolio of stocks, bonds, and other securities. All right. So you can look at any mutual fund. You can go on Vanguard, whatever. You can look at their bucket. That particular fund bucket is going to show you everything that they're investing in. Okay, so it's not like it doesn't trade like a stock. All right, it I would say it doesn't trade as a stock. Like, you have to trade it. Basically, you go through the institution, and when you trade in and out of a mutual fund, it's definitely not like a stock. They put it in the next day. It's not a real-time kind of transaction. It's nothing like that. They put it in essentially the next business day, from my experience with buying mutual funds. So why is this important? You want to know the income and how you get money. Income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Funds often give investors a choice: either receive a check for distributions or to reinvest their earnings and get more shares. I underlined that just because it reminded me of the dividend reinvestment plan. So mutual funds, they actually call your dividends, they call them contributions. So your reward for having a mutual fund with this institution is your contribution. And that's where we're talking about that compounding interest. Your 10,000 is in, you get a contribution. It's like $100 and some dollars. That's great. And it just keeps going on and on and on. But most people, I wanted to underline this because for me, I'm not getting a check for my contribution. It's getting reinvested back, and I'm buying more shares of the mutual fund. Okay. Let's see. Next thing, ETF. It's kind of like a form of mutual fund. An exchange, because I mentioned this before, SPY is on the stock market, is an exchange traded fund. It's a type of security that involves a collection of stocks that often tracks an underlying index, although they can invest in a number of industry sectors or use various strategies. ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like an ordinary stock. And I just mentioned SPY, but I'll read it. A well-known example is SPDR, S&P 500 ETF, which stock symbol is SPY, which tracks the S&P 500 index. So ETFs, literally exchange traded fund, they track industry sectors. So whether it's tech, whether it's health, whether it's retail, whatever, it is based on a collection of stocks in that particular sector. That's where it differs from mutual funds. Mutual funds can be from anywhere. It could be stocks, bonds, whatever they want to collect. ETFs are based on sectors. So waste management is another sector. There'll be all the stocks of waste management companies, whether it's Waste Management itself, Republic, Waste Connections. It'll all be in that ETF, and it does trade just like a stock. So I can go log into my stock account, trade an ETF. I will get my money that day right then and there. It's real time. It's instant. All right, we're going to go over some more just generic terms. You'll hear FANG. Don't be alarmed. No one's coming to get you. But it's important to know these things. It's a nomenclature. It's just a language that's really not hard. And it's just FANG is an acronym that refers to stocks of 5 prominent American tech companies. And I put this after ETF to give you a real life example. This isn't an ETF, but it's essentially the term mimics what an ETF is. All right. It's remember, it is a collection of stocks in a particular sector, and the sector here is tech. So there's Facebook, Amazon, Apple, Netflix, and Google. All right. Even though Google's named Alphabet, they still use the G. So Facebook, Amazon, Apple, Netflix, Google. This would be an example of like an ETF if you bought it, but it's just a normal financial term. How is FANG doing on the market? That's all that is. Nothing complicated. All right, what is an index fund? Index fund is a type of mutual fund or ETF with a portfolio constructed to match or track the components of a financial market index, such as Standard and Poor's 500 index. An index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. These funds follow their benchmark index regardless of the state of the markets. An index fund is not actively managed and mirrors a sector such as tech, waste management, or health. Now, the ETF sector, I just gave you an example of that. So the difference here is the ETFs are actively managed. They have a manager and they're trading in and out of stocks based on that sector. Here, the index fund, it's not actively managed. It's very passive. If you have 500 companies in S&P 500, it's going to pick enough companies in that index fund to mirror the performance of the S&P 500, and that's it. And that's what it's going to be. It's just going to mirror the index, and that's all. It's lower operating expenses and low portfolio turnover, meaning they're not going to sell in and out of stocks. And low operating expenses is when people have mutual funds or ETFs, the manager takes a fee. So you have a mutual fund with Vanguard, they're going to take a fee. If you have an index fund with Vanguard, they're going to take a fee, but it's going to be considerably lower because it's not actively managed. Okay, real quick, real simple stuff. Opening bell. You ever hear that? I don't know what's the big deal with the bell, but that basically says the morning has started, people can start trading stock. That's all that means. The opening bell refers to the moment a security exchange opens for its normal daily trading session. So give you an example, the New York Stock Exchange starts at 9:30 a.m. If you're in Central Time like I am, it starts at 8:30. And then, of course, there's the closing bell. That's when everything stops. The trading stops, and you'll have the futures market start and all that other stuff. But the closing bell ends the active trading on your platform. So say if you're on E-Trade, 4 p.m. Eastern comes around, or 3 p.m. Central, where I am, or even later on the West Coast, I believe that would be 1 p.m. The market's closed. You cannot make any more trades. The trades won't go through until the next day when the opening bell happens. That's all that means. This is good. We were talking about this earlier. The S&P 500. People are like, oh my gosh, what is that? I never heard of that, and I don't understand it. And I would hear it as a college student, but this legitimately is something really easy. It is a market capitalization weighted index of the 500 largest U.S. public traded companies. So S&P and them literally picked the 500 biggest companies and found a measurement system for them. That's all that means. And it seems to be so difficult, but it's not. The index is widely regarded as the best gauge of large cap U.S. equities. As a result, there are many funds designed to track the performance of the S&P. Remember, we just talked about that. The index funds. There are index funds that mirror S&P 500. They're out there. A lot of things on Vanguard, but there's stuff on Fidelity and stuff like that where they just mirror the S&P 500. Again, it's not complicated. Some people, when the stock market started, these are two different people. They're two different last names. They came together. They say, hey, let's just measure the performance of companies in the United States. And they end up coming to 500, and they say, okay, we're just going to come up with a mechanism and spit out a score. So anytime you go on MSN or you open up the paper, Yahoo Finance, and you look at the score of the S&P 500, that's all that means. The S&P measurement of the 500 companies is X. It's 3,000 points. It's 4,000 points. It's not complicated. Same thing with the Dow Jones. It's Dow Jones and Company is one of the world's largest business and financial news companies. They started the Dow Jones Industrial Average, which is literally just what I just described with the S&P. It tracks publicly owned corporations as one of the most watched stock indexes in the world. Now, the difference between Dow Jones and S&P has 500 companies. The Dow Jones focuses on the top 30 companies according to their measurements. So the Dow Jones can be the Dow Jones and S&P scores can vary greatly. The Dow Jones could be up while the S&P can be down, and vice versa. So it's not exactly, they don't mirror each other, because Dow Jones is significantly smaller, not in cap rate, but smaller in just quantity wise. So the 30 companies could literally be going through the roof while S&P is, flat. Okay. Damn, this went by so fast. Not really. We're at part 4, and this is the last part, and it's just why we do this, and it's because of the racial wealth gap. Now, I'm going to read you some things that are damning, but it really means a lot to me to do this, because it took a lot for me to get here, and it took a lot of just learning, messing up, learning. And I'm hoping I can pass this information and pay it forward so people don't have to have so many bumps in the road as I did. And I hope I can lessen the learning curve. Okay. And this is why we need to lessen the learning curve. For decades, economists have noted a substantial gap between white households and those of racial minority groups in the U.S. in the terms of net worth. As of 2016, white households had a median net worth of $171,000 compared to $17,600 for Black households and $20,700 for Latino households, according to the Federal Reserve. That's stark. Okay, so what can we do about it? The big push right now, especially with the new president coming in, everyone wants to cancel student loan debt, which is great. Please cancel my shit. I would love that. It's a proposal, but you got to remember, it's not going to solve all the problems, including the generations that come after us. I believe this is going to be a one-time thing. They're just not going to be forgiving student loans every year. It's just not going to happen like that. So, you want to think about the generations after you, not necessarily your kids, but maybe your little brothers or little sisters or your cousins that's right behind you that are 10 and 8 or 12 or whatever. They haven't hit college by the time, this is going to be forgiven. So the cycle can start back up again. So that is the biggest strain, but we got to start thinking beyond that. And that's where financial literacy comes in. Financial literacy has literally changed my financial life, really my life, because I've been able to get out the hood. Like I don't live in the hood no more. This is great. And I don't have to, mind my finances as much anymore. I'm not frustrated as much, which boiled over into my personal life because I was broke. I was frustrated. I couldn't do what I wanted to do. I wanted to take that trip and I couldn't. I didn't have the money. I wanted to do this and with my friends and I couldn't because I didn't have money. So financial literacy allowed me to get to a better place where I wasn't living paycheck to paycheck, and I was able to get in my head, oh, I know I need to get a roadmap together. And one of the roadmaps is getting higher wages. I need to get a higher paying job for now until I can figure out another way to, sustain my lifestyle. And financial literacy allows you to buy stock. That's a big thing. You want to talk about real estate. You can also talk about stock because that's another way to get better off in this country, paying a company to grow their assets and you getting rewarded for them growing their stock price, and then you cash out. That's what it's the whole thing of long-term investing. It's really that simple. So you legitimately want to use the financial literacy, especially the things you can find in this very free course, to use to get a higher, think about it, having your roadmap, get a higher paying job, put money in your 401k, in your IRA, in your online banks, and putting stuff to the side for your generations to come, and then actually buying stock. Now you're not living paycheck to paycheck. Now you're not worrying about, is my retirement going to be funded? Now you're just focusing on growing your money, growing your freedom, because your time is very valuable. If you can get to a place where you don't have to work every day, working part-time or not working, period, you just change your life, just change your family's life. And that's important. That's fantastic. All right. So I just wanted to spend a little bit of time for the Black-owned stocks out there. They're listed here. They're Urban One, it's Broadway Financial Corp. There's all these companies here, but they're not a lot in comparison. But I do want people to understand that they are out there, just Black-owned stocks. They're owned by Black people, operated by Black people, and something to think about when you are investing. All right, and these are Black-owned banks. This is really, really special to me. Just constructing this list. This list is all the Black banks that I have found online. And one of the things I loved about this is it let me know that we can do a lot of different things on a broad scale. These like First Tuskegee Bank, Industrial Bank, Commonwealth. The only bank I've really heard of before making this list was One United Bank, and of course, and I underline Liberty Bank because this is one of the first banks I've ever had an account with, and of course, hometown New Orleans, Louisiana. It's just how we get down. But outside of that, I have never heard of these things, and they are in these communities, and they're giving back, and they're giving an avenue to their communities. And I wish that was, known more. I wish they would have known as much as Capital One or Chase or, whatever you can come up with. I really feel lucky that I was able to grow up in a city where I knew this bank, where it seemed just typical, and I didn't know that this wasn't typical. There are other banks out there, and just want to highlight them, give them some shine, give them some love. All right, I think, oh snap, I think I'm done. I can't believe this. Am I done? Are these all the slides I have for y'all? Wow. So I don't know how long that was, but again, I'm going to break it up in parts. Remember, it's I want you to think ahead. I want you to actually put thought into your money. I want you to put thought into your investments. It's worth the time. Your family's worth the time. And it's more to life than just working and paying bills. It really is. Well, until next time, it's going to be a while because this took a lot of work. And I'm going to holler at y'all. Oh, again, I'm going to post this video. I'm going to break it up in parts. I'm going to put one full version and break it up in parts. And this actual slide deck will be in the description in case you don't want to read through it. Don't want to listen through these slides, go through these slides. You can legitimately just click on the link and see each and every slide that I did. All right, peace.